as they have been for the last several weeks. In fact, Wall Street is on its second longest bull run in history. The S&P 500, the standout performer. It is up more than 260% since the low in March 2009. That is its third strongest ever rally. And CNN's Fear and Greed Index firmly in extreme greed right now. That's quite a swing since it showed signs of fear just over 1 week ago. Let's break this down with Alan Nuckman coming to us from the floor of the CME. He's Chief Options Strategist at Bullseye Option. Alan, in some way, the market's just catching up with you. You have been optimistic for a while, pointing out that the fundamentals in the U.S. look good. What's driving this?
It's just focus on performance. You talked about that 260% bounce off that extreme low. The market's been going straight up and conditions have been improving. You can see now a new day, a new high. There are 34 new highs. I guess this is 35 new highs year to date in the S&P. So it's certainly not broken. And what I find most interesting is that we've had probably the most uncertain political situation that I've seen in my lifetime, but the markets have been able to shake that off. Regardless of politics or policy, we continue to perform.
Yeah, that is right. That's why a lot of people are also surprised and speak to that resilience the market seems to have. That 260% gain is extraordinary, and I guess sort of underscores people who say, you want to stay invested, you want to stay in the market, don't let your emotions rule you. For people who were scared, though, and sat it out, Alan, is it too late to participate now? Do we look like we're in an overvalued situation, or is this an accurate reflection of U.S. fundamentals?
We've been in an overvalued situation for some time. We've already had a major run, but I could have said that a year ago, 2 years ago, 3 years ago, 4 years ago. So it depends on your time frame at these levels, and it's about really controlling risk. What I'm paying attention to right now is we haven't had a major pullback or even a minor pullback of more than 3% since November. So that's in a pretty extended streak without any real volatility or any unwinding. So that's something to pay attention to. But let's focus on what's driving the market and its performance of this earnings. We've seen 2 double-digit earnings quarters in a row. Now, this quarter, we're not expecting that much growth, maybe 5% growth, but still, it's been a very nice move so far as corporate earnings go.
Alan, sometimes when people look at these markets, so, if stocks are going up, you expect other things to be falling. People moving money out of one area, asset class into another. We haven't really seen that happening with bonds. We've seen some markets kind of moving in tandem in a way that strikes people as a little strange. Is that something you worry about?
Yeah, typically you're taught that, money moves from one asset class to another, and you would see money come out of stocks and go into treasuries. That really has been happening. They've been moving on their own. It's interesting what we're seeing right now as far as rates go. We bottomed out here recently in the long-term rates and did have a bit of a bounce in the last week or so. We've also seen other markets move in opposite directions. Oil was up 5% last week, but gold was down $25. So it's very different drivers for different asset classes, but that means opportunity. And I think if you come back to oil being back above $50, something I mentioned weeks and weeks ago, that if we could get some strength out of the oil sector, that is a class of a sector in the stock market that hasn't participated in this rally that could be the next catalyst, the next buoy higher here if those energy companies can start to perform.
Yeah, great point, Alan. It is something we need to watch closely. Alan Nuckman for us. Thanks so much.